Most traders lose money during the first part of the session for one simple reason. They are guessing. They react to fast candles, chase momentum, and enter before the market is actually shown where buyers and sellers are positioned. The Morning Range Breakout indicator is built to solve that problem. Instead of manually drawing levels and trying to interpret every move in real time, this indicator maps the key price zones automatically and helps you focus on how price reacts once real volume comes in. And that's the key idea here. This framework gives you structure first, then signals second. Now let me show you what you're actually looking at on the chart. The first thing this indicator maps is the main session range before the New York Open. On stocks, that's your pre-market range from 4 a.m. to 9:30 a.m. Eastern Time. On futures, that same concept acts more like the overnight session range leading into the cash open. And on crypto, since there is no true pre-market, it works more like a New York liquidity window range. Different market, same idea. Price forms a range before the main session begins, and that range often becomes the map for the rest of the day. Right here you can see the main range high, and down here you can see the main range low. On stocks, these are labeled PM high and PM low. The shaded box between them shows the full range, and right in the middle you'll see the midpoint or equilibrium. That midpoint matters because it helps you judge whether price is holding the upper half of the range or the lower half. If price is accepting above the midpoint, that usually shows more strength. If price is accepting below it, that usually shows more weakness. The indicator also plots several higher context levels. Up here you'll see the weekly high and weekly low. In gray, you'll see the previous week high and previous week low. And the yellow line is the daily pivot, which is based on the previous day's price action. These levels matter because when several of them start clustering in the same area, you get confluence. And confluence is where some of the cleanest reactions happen because more traders are focused on the same zone. So before the market even opens, the indicator has already given you a full structure map. The range high, the range low, the midpoint, weekly levels, previous week levels, and the pivot. Then after the market opens, it adds one more important piece, the opening range. The opening range is based on the first 15 minutes after the New York Open. So from 9:30 a.m. to 9:45 a.m. Eastern Time, the market forms another smaller battle zone. Once that candle closes, the indicator plots the OR high and OR low. Those levels become important momentum boundaries for the rest of the morning. Now, once all of that structure is on the chart, the strategy basically comes down to three core setups. The first setup is the break and retest. This is the main continuation setup. If price breaks above the main range high, the goal is not to chase the breakout immediately. Instead, you wait for price to pull back into that level. What used to be resistance should now act as support. If price retests that level, holds it, and confirms the move, the indicator can print a break/retest long signal. That tells you buyers are defending the breakout. On the short side, it's the same idea in reverse. If price breaks below the main range low, then pulls back into it from underneath and rejects it, the indicator can print a break/retest short signal. The logic is simple. Break the level, retest the level, confirm the move. Then consider the entry. That setup tends to work best on trend days when the market is showing real directional strength. The second setup is the opening range breakout. Once the opening range is formed, the OR high and OR low act like momentum boundaries. If price breaks and holds above the OR high, that suggests buyers are taking control after the opening consolidation. If price breaks and holds below the OR low, that suggests sellers are in control. The indicator can mark these as or breakout signals. But the important point here is that not every wick through the line matters. A quick poke through a level is not the same as real acceptance. What matters more is whether price can actually close outside the range and hold. And that's why the opening range is useful. It helps separate noise from real expansion. The third setup is the bounce or rejection trade. This one usually works better on range days or slower sessions. If price pushes up into a key resistance level, like the main range high, weekly high, or previous week high, and then gets rejected, the indicator can print a re-sell arrow. That tells you sellers defended the level. If price drops into a key support level like the main range low, weekly low, or previous week low, and then bounces, the indicator can print a set buy arrow. That tells you buyers defended support. These are not breakout trades. These are reaction trades. You're trading the move away from defended structure, not continuation through it. And that leads into one of the most important concepts in the whole framework. Context matters. Not every signal should be traded the same way. A breakout setup makes more sense when the market is trending. A bounce or rejection setup makes more sense when the market is ranging. And when the market is choppy and stuck in the middle of nowhere, sometimes the best trade is no trade at all. That's why the system also pairs well with the regime detector, which is the second free indicator. The regime detector helps you judge whether the market is behaving in a more trending way or a more choppy way. So instead of guessing what kind of day it is, you can match the setup to the environment. This strategy works best as an intraday framework, especially on lower execution time frames like the 1 minute, 3 minute, and 5 minute charts, where session structure is easiest to read. And like any real strategy, risk management is not optional. Define your risk before entry. Place stops beyond the level or structure that actually invalidates the setup. Don't widen stops emotionally. Don't force trades in dead zones, and if the market conditions start degrading, reduce size or step away. No indicator can save someone from bad discipline, but structure absolutely helps. So the workflow stays simple. Map the levels. Wait for the opening range to form. Let the market reveal whether it's trending or choppy. Wait for price to interact with structure. Demand confirmation. Then execute with risk control. And if you want another layer on top of that, CyberTrader AI adds extra trend filtering and signal filtering to help with trade quality. And CyberTrader Sidekick gives you the broader market context, things like sentiment, trending tickers, and market moving information, so you can understand what is actually driving the session.